$84.41. That's the number on your screen right now if you pull up silver futures. And I need you to stop whatever you're doing and really look at that number, because by the time this video is over, you're going to understand exactly why that number is one of the most misleading figures in the entire global financial system today. Not misleading in a vague, hand-wavy conspiracy kind of way, misleading in a cold, documented, data-driven way that I'm going to walk you through step by step with real COMEX filings, real CME margin data, real Shanghai exchange prices, and real vault inventory reports. And here's the thing that's keeping me up at night. This particular kind of deception always plays out over a very specific window, a window that closes on Monday morning when the markets reopen. This is a Friday. Today is Friday, March 13th, 2026. The US futures markets are closed or closing. The paper traders are logging off. The margin desks are quiet. And sitting beneath that peaceful $84.41 price on your screen is a physical silver market that is doing something I have genuinely never seen before in the decade plus I've been studying precious metals. Stay with me because the gap between what that number says and what reality says is about to become impossible to ignore. Here's where I want to start, because I want to give you the full picture before we get into the mechanics. Silver hit an all-time high of $121.62 per ounce in late January of this year. $121.62. A price that almost nobody in mainstream finance predicted 12 months ago. Then, in a matter of days, it crashed. Not a gentle correction, a violent, engineered-looking collapse that took silver from north of $120 all the way down to an intraday low of $64.14. That's a 47% crash. In days. While the physical supply data continued to scream shortage. And now we're sitting at $84.41 on a Friday afternoon. Silver's up 161% year over year. Gold is trading at $5,093 per ounce, more than double where it was 18 months ago. And yet the screen is telling you silver is just sitting there, calm, contained, almost boring. But the COMEX vaults tell a completely different story. And that story is what I need you to understand before Monday. Let me give you the foundation because this matters. I'm not asking you to take my word for any of this. Every number I'm going to share with you comes from official exchange filings, CME warehouse reports, and documented market data. You can pull these yourself. According to CME Group warehouse data as of March 9, 2026, COMEX registered silver, that's the metal that's actually deliverable, actually available to back the paper contracts being traded, stood at approximately 88.78 million ounces. Now that sounds like a lot, but here's the context that changes everything. In October 2025, registered silver was at 167 million ounces. In just 5 months, it's been cut nearly in half. That's a 47% drawdown of deliverable silver sitting inside the system that's supposed to back the world's most important silver pricing mechanism. And the drainage rate, as of the most recent data, was running at approximately 785,000 ounces per day. Every single day, nearly 1 million ounces of silver is leaving the COMEX warehouse system. Now here's where the math starts to get genuinely alarming. According to data from goldsilver.ai, which tracks this in real time using official CME reports, the current paper-to-physical ratio in the COMEX silver market is 7.4 to 1. That means for every ounce of registered deliverable silver sitting in a COMEX-approved vault, there are 7.4 ounces worth of paper claims outstanding. And their COMEX stress index, which combines coverage ratio, inventory trend, paper leverage, and vault outflows into a single score, is currently sitting at 84 out of 100. The all-time high ever recorded is 88. We're at 84 right now, today. Before I go any further, quick message for people who aren't subscribed yet. My analytics show about 3 out of 4 people watching this right now haven't hit that subscribe button. If this kind of analysis, real data, real numbers, no agenda, is cutting through the noise for you, I genuinely appreciate the subscribe. It tells me who the committed community is, and it helps the algorithm surface this content to more people who need to see it. Now, back to the vault numbers because this is where it gets serious. I want to give you a historical framework because what's happening right now has happened before, not once but 3 times in the last century, and each time it followed the same sequence. The first was in 1968. The US government had been promising silver-backed dollars while simultaneously creating far more paper dollar claims than they had silver to back them. The official price said one thing, the physical market said another. The Treasury tried to hold the paper price while the real metal quietly drained out of Fort Knox and government vaults. Then one day the divergence collapsed, not gradually, not gently, They simply ran out. The silver window closed, and the people holding paper got the paper price. The people holding physical got the real market that emerged afterward. The second was 1980. The Hunt brothers had accumulated an enormous long position in silver, and at the same time the industrial and monetary world was waking up to a structural shortage. Silver went from under $11 to $50 an ounce in less than a year. And then on January 17, 1980, the COMEX changed the rules mid-game. They restricted new long positions and raised margin requirements so severely that leveraged longs were forced to liquidate. Silver crashed from $50 to $10 in 2 months. The people holding paper contracts got destroyed. The people holding physical silver rode out the crash and kept their metal. The third was 2011. Silver ran from $18 to nearly $50. Again. And again the CME stepped in. 5 margin hikes in 2 weeks, and the leveraged paper longs got wiped out. Physical holders kept their metal. The price suppression was temporary. By the time silver touched $30 again a few months later, the structural supply story was already rebuilding. Now I need you to notice something. In all 3 of those situations, there's a pattern. Paper price diverges from physical reality. Exchange raises margins. Paper traders get demolished. Physical holders survive. Then the underlying fundamentals reassert themselves, usually at a higher price. We're in that exact setup right now. But this time, several factors have stacked up simultaneously that make it more extreme than any of those 3 historical precedents. Let me walk you through the March delivery situation, because this is the smoking gun hiding in plain sight. On February 27, 2026, that was first notice day for the March silver contract. 10,526 contracts stood for physical delivery. Each COMEX silver contract is 5,000 troy ounces. Do the math. 10,526 contracts times 5,000 ounces equals 52.63 million ounces of silver that someone decided they wanted in their hand, not as a paper settlement, not rolled to the next contract, physically delivered. Real bars, real metal. That was 59.3% of all registered deliverable silver in the entire COMEX system demanded in a single delivery month. And this is coming off a February that was already extraordinary. According to data published by analysts tracking CME delivery reports, February 2026 saw 5,036 contracts physically delivered, 25.18 million ounces. That's the highest February delivery volume in modern COMEX history. February is traditionally one of the quietest delivery months. A typical February delivers somewhere between 3 and 5 million ounces. This February delivered more than 5 times the historical average. Combined with January, where 33.45 million ounces were physically withdrawn from COMEX in just 7 days, representing 26% of the entire registered inventory in a single week, we've seen approximately 75 million ounces, that's 85% of current registered inventory, turned over out of COMEX vaults in just 60 days. Think about what that means. Think about it like your bank account. If 85% of your bank's actual reserves had been withdrawn by depositors in 60 days, would you consider that bank healthy? Would you trust the number on the ATM screen? Now here's where it gets worse. And I mean genuinely worse, not podcast hyperbole, actual worse. The managed money positioning on COMEX, that's the speculative traders, the hedge funds, the momentum chasers, collapsed by 77.72% year over year. In February 2025, managed money held 54,415 contracts long. By February 2026, that had fallen to 12,121 contracts. The speculators left. The froth is gone. And yet the delivery demand kept accelerating. That means the entities standing for physical delivery in this cycle are not retail speculators riding a momentum trade. These are institutions and industrial users who actually need the metal and have decided they don't trust the rollover. They're not betting on higher prices. They're taking the silver before someone else does. According to COMEX delivery reports, JP Morgan and Citi were among the entities taking significant delivery positions in the January reports. This is the same JP Morgan that paid a $920 million fine in 2020 for manipulating precious metals futures markets. And now they're on the long side, taking delivery. The same bank that spent years suppressing the price is now among the entities quietly pulling physical silver out of the system. You can look up that fine, it's documented, and the delivery notices are public record on the CME website. Let me talk about China, because this is the force that most people in the Western financial media are not fully understanding yet. On January 1st, 2026, the Chinese government officially implemented new export control rules on silver. Silver was reclassified from an ordinary commodity to a strategic resource requiring government licensing. Of the companies that applied, only 44 received authorization to export silver over 2026 and 2027. Those 44 companies represent gatekeepers over approximately 121 million ounces of annual silver exports. Exports that previously flowed freely to the West, to London, to New York, to global industrial supply chains. That 121 million ounces represented roughly 60 to 65% of global refined silver traded internationally. Gone. Effectively overnight. Here's why this matters specifically for the weekend price you're staring at. The Shanghai Futures Exchange, the SHFE, has been trading silver at significantly higher prices than COMEX. As of this past week, SHFE silver was equivalent to approximately $103 per ounce in US dollar terms, while COMEX silver sat around $84 to $89. That's not a small regional premium, that's a structural break. Same metal, same planet. Eastern physical buyers paying triple-digit prices because that's what it actually costs to move real ounces in the world's largest physical silver-consuming nation. What does that divergence create? Arbitrage pressure. Any trader who can buy silver cheaply through the paper system in New York, stand for delivery, and sell it into the physical market in Asia is going to do exactly that. And that arbitrage, that flow of metal from west to east, is precisely what's accelerating the COMEX vault drain we've already discussed. Let me also show you what happened with lease rates, because this is one of the most important signals in the entire metals market, and almost nobody covers it. Silver lease rates, the rate at which large institutions lend physical silver for a yield, normally sit at around 0.3 to 0.5% annualized. That's the normal, healthy range when supply is abundant and the system is functioning. During the stress events of late 2025 and early 2026, one-month silver lease rates exploded to 8% annualized, with intraday spikes reported at the Japan Bullion Market Association reaching as high as 34.9% on October 9, 2025. 34.9%. For context, when you see lease rates that high, it means institutions that need to borrow physical silver for delivery are paying emergency rates to access it. It means the metal is not there when they go looking. A lease rate of 34.9% is the precious metals equivalent of a bank run in slow motion. Even after the January correction that took silver from $121 down to $64, lease rates remained elevated in the 5 to 8% range, multiples above normal levels. The physical tightness did not go away because the paper price crashed. And the London Bullion Market Association, the LBMA, which is the heart of global spot silver trading, saw its eligible silver stocks fall to approximately 155 million ounces by early 2026. That sounds large until you measure it against floating annual demand running between 900 million and 1.2 billion ounces. You don't need to be an economist to see that the numbers don't balance. Stick with me here because this next part is the most critical piece of all. The disconnect between what the paper market is saying and what you'd experience if you actually tried to buy physical silver today. The $84.41 you see on the screen is a COMEX futures price. It's a financial contract. It's settled overwhelmingly in cash. According to analysts who've studied the ratio, by late 2025 there were approximately 356 ounces of paper silver traded for every single ounce of physical silver held in registered vaults. 356 to 1. Now think about what that actually means. The price discovery mechanism for silver, the number on your screen that tells you what silver is worth, is being set by a market where 99.7% of the activity is paper with no physical backing. It's like pricing real estate based on a market where 356 out of 357 transactions never actually involve a building. And here's the thing that should bother you most. We know this system works when people don't ask for delivery. The whole structure of leveraged paper markets depends on the assumption that nobody demands the underlying asset all at once. That assumption, according to the analysts at TradingKey who've studied this in detail, failed in early 2026. People started asking for the silver, and they keep asking, and the vault data confirms they're getting it, until there isn't enough left to give. The Exchange for Physical Spread, the EFP, which measures the gap between COMEX futures and London spot prices, widened from its historic average of 25 cents per ounce to over $1.10 per ounce during the tightest periods of 2025 and early 2026. A $1.10 EFP spread means the market is paying a significant premium just to access metal in a different location. That spread should be nearly zero in a healthy, abundant market. Let me ask you something. If you walked into your local coin dealer today, and I mean today, this Friday, and tried to buy 10 1-ounce silver bars, what would you pay? If the answer is significantly more than $84.41, then the screen is lying to you. And in most markets right now, that's exactly what you'd find. Because the gap between what institutional paper traders do and what someone who actually wants silver in their hand experiences is measured not in cents, but in dollars per ounce. Now let me address the elephant in the room, because I want to be completely honest with you. There are legitimate analysts who argue this isn't manipulation, that physical premiums reflect supply chain logistics, refining costs, and distribution friction rather than exchange fraud. And to some extent, that's true. Refiners prioritize large institutional bars. Retail products require extra processing. When demand explodes and refining capacity is constrained, premiums widen for real operational reasons. But here's what that argument cannot explain. Why the Shanghai Futures Exchange, a physically settled, institutionally used exchange, is pricing silver at the equivalent of $103, while COMEX sits at $84. That's not a retail premium for a 1-ounce coin. That's a major exchange, with major institutional participants paying $19 more per ounce for the same metal on the same planet at the same time. The operational friction argument doesn't close a $19 gap. Now let me show you the mechanics of what happens over a weekend, specifically this weekend, and why the title of this video is not hyperbole. When U.S. futures markets close on Friday, the paper traders who set the COMEX price go home. But physical demand doesn't stop. Industrial users in Asia don't stop needing silver for solar panels and semiconductors and electronics because it's Friday afternoon in New York. Central bank decisions made over the weekend don't wait for COMEX to reopen. Geopolitical events, and with the Iran situation still unresolved, with Brent crude crossing $100 a barrel this week, with the Strait of Hormuz still under threat, those events happen 24 hours a day, 7 days a week. And here's the specific thing I'm watching this weekend. The COMEX stress index sits at 84. The March delivery cycle has already consumed 59% of registered inventory on just first notice day. The drain at 785,000 ounces per day is continuing. Inventory depletion estimates put the current pace at approximately 62 trading days until registered stocks hit critical threshold. And that estimate is based on current withdrawal rates, not accelerating ones. Asian markets will reprice silver based on their physical reality, not COMEX's paper reality, when they open. The Shanghai gap of roughly $19 per ounce creates enormous arbitrage pressure. And when New York opens Monday morning, it will be catching up to a weekend of physical reality. This has happened before. After the Hunt brothers situation in 1980, after the 2011 margin hike cascades, there's always a moment where the paper price tries to hold and then cannot hold, and the gap closes violently, usually upward. Let me talk about the CME's role in all of this because it's documented, it's official, and people need to understand it. In December 2025, when silver was approaching $84 an ounce, ironic that we're basically right back there, CME Group issued advisory number 25-393. They raised maintenance margins on March 2026 silver contracts from approximately $22,000 to $25,000 per contract. That's a 13.6% increase intended to cool a market that had gained 30% in a single month. Silver didn't listen. Silver kept going. So on December 30th, CME struck again with a 30% increase, bringing the total initial margin to $32,500 per contract. In the span of 1 week, the capital required to hold a standard silver position increased by nearly 50%. Then, in January 2026, another increase, from 11% to 15%. A 35% jump in margin requirements announced late on a Friday night, when the market had already whipsawed silver from $91 to $75 in a single hour. Then again in February, margins went from 15% to 18%. Each time the effect was the same. Leveraged paper longs, the speculative traders, the retail momentum chasers, the hedge funds running algorithmic strategies were forced to liquidate, forced to sell, and the price crashed. Not because the physical demand disappeared, not because a mine suddenly flooded the market with new supply, because the CME changed the cost of holding a paper contract and forced weak hands out. You can look this up, CME Advisory 25-393. The margin tables are public, the dates are documented. Between 2016 and 2025, banks including JP Morgan, UBS, and HSBC paid over $1.2 billion in spoofing-related fines for manipulating precious metals prices. Multiple traders were convicted. This is not conjecture, it's on court records. The question you have to ask yourself is whether the institution that pays $920 million for manipulating silver prices then turns around and raises margins at the exact moment silver is threatening to break out, whether that's coincidence. The math of the timing is something you should evaluate for yourself. Now let me make this personal, because all of this data, the vault drawdowns, the lease rates, the Shanghai premiums, the CME advisories, what does it actually mean for you sitting here on a Friday afternoon? Here's what I think you need to understand practically. If you currently hold silver ETFs like SLV or PSLV, you need to understand what you own. An ETF is a paper claim. It's not a vault in your name. It tracks the COMEX price, the $84.41 we keep talking about. In normal markets, this is fine. In a market where paper to physical ratios are 7.4 to 1 and the stress index is at 84 out of 100, you want to think very carefully about what happens to your ETF in a scenario where the paper pricing mechanism breaks. If the exchange moves to cash settlement, which is one documented possible outcome of a delivery shortfall, your ETF settles at the cash price, whatever that is, not at the physical market price where the real metal clears. If you hold physical silver in your own possession, this weekend does not change your underlying position. You own the thing. You're not subject to margin calls. You're not dependent on someone else's vault integrity. The $84 number on the screen does not affect what you're holding. What matters is the price when you choose to transact. If you're considering entering the silver market, and I want to be very clear that nothing in this video is financial advice, you need to make decisions appropriate to your own situation and risk tolerance. Then the information I've shared today suggests a few things to consider. The paper price and the physical price are not the same number. What you pay at a dealer will include a premium, and that premium has expanded significantly as the structural tightness has built. Bank of America's head of metals research, Michael Widmer, published targets ranging from $135 to $309 per ounce before year-end 2026. JP Morgan has an $81 average estimate. Independent analyst Jochen Steiger, a Swiss commodity veteran, projects a sequential target structure of $111, then $146, then $185, within 12 to 18 months. Those are not my projections. I'm sharing what institutional and independent analysts have published. The spread is enormous, the uncertainty is real, and the volatility has been some of the most extreme in modern silver market history. Any position you take needs to account for the fact that a journey from here to any of those higher targets will not be linear. The January crash from $121 to $64 proved that. What I'd tell you to watch specifically as this weekend closes and Monday approaches. Watch the COMEX registered inventory number when it updates Monday evening. GoldSilver.ai publishes it in near real time from official CME sources. If it drops below 85 million ounces, you're watching the stress index approach its all-time high of 88. If it drops below 80 million and March delivery demand continues at current rates, the system enters territory we genuinely have no modern precedent for. Watch the SHFE to COMEX spread. If Shanghai prices are still at the equivalent of $100 or more, while New York sits at $84, that arbitrage pressure is still building. That gap doesn't close because someone decided to close it. It closes when either the physical price comes down because supply improves, which nothing in the data suggests is happening, or because the COMEX paper price is forced upward toward physical reality. Watch any CME advisory announcements over the weekend. CME has shown it's willing to change the rules on a Friday evening when it thinks the market is getting away from it. CME advisory number 25-393 was the precedent. Another margin hike announcement over a weekend would be a signal, not a random operational decision. Watch the silver lease rate. If it spikes back above 5 to 8%, it means institutional demand for borrowed physical is surging again, and the tightness is intensifying. Sub 1% would suggest relief. Anything in the 5% plus range is a warning. And watch the geopolitical situation with Iran and the Strait of Hormuz. Silver has dual drivers right now: safe haven demand tied to conflict risk, and industrial demand tied to its fundamental role in solar panels, electric vehicles, semiconductors, and AI data center infrastructure. Goldman Sachs projects data center power demand will increase 165% by 2030. Every one of those data centers is packed with silver-containing components. That demand doesn't respond to paper price signals. It responds to the need to build the infrastructure. Let me bring this full circle because we started with $84.41 on a screen. That number was set by a paper market where 356 paper ounces back every real ounce. A market where registered inventory has been cut almost in half since October. A market where 59.3% of all deliverable silver was demanded in a single month. A market where Shanghai is paying $19 more per ounce for the same metal. A market where lease rates spiked from 0.3% to nearly 35% at their peak. A market where the CME changed margin rules at least 4 times in a 2-month window, each time during a rally that was threatening to expose the gap between the paper price and the physical one. Think about the 3 historical precedents I described. The silver window of 1968. Paper promises eventually met real shortfall. Silver Thursday of 1980. The exchange changed the rules. The leveraged paper holders lost. The physical holders kept their metal. The 2011 margin cascade. Same mechanics, same outcome. In every case, the paper price was a lagging indicator of what physical reality was doing. In every case, the people who understood the physical fundamentals were better positioned than the people who trusted the screen. I'm not predicting a specific date. I'm not telling you silver goes to any specific price on Monday. What I'm telling you is that the documented data, official COMEX filings, CME warehouse reports, SHFE pricing, lease rates, delivery data, all of it tells a story that the $84.41 on your screen is not fully telling. And that gap, whatever its exact cause, has a history of resolving violently rather than gracefully. The people who didn't see it coming in 1968 didn't fail to see it because the warning signs weren't there. The U.S. Treasury published the vault data. The delivery demand was visible. The premiums in the physical market were widening. They failed to see it because it seemed crazy that something that had worked for decades could stop working. Paper claims on silver had always been honored, until they weren't. Right now, as you watch this on a Friday, the markets that set the paper price are quiet. The vaults that hold the physical are draining at 785,000 ounces a day. Shanghai is paying $19 more per ounce than New York. The COMEX stress index is at 84, and Monday is 60-something hours away. The question isn't whether you believe me. The question is whether you believe the vault data, the delivery reports, the lease rates, and the Shanghai price, all of which are pointing the same direction. You can check every single number I've cited. CME Group publishes warehouse reports daily. GoldSilver.ai compiles them in real time. The SHFE prices are publicly accessible. The CME advisories are on their website. The JP Morgan fine is court-documented public record. I'm not asking for trust. I'm asking for 20 minutes of your time to look at numbers that most people will never look at. Because the people who look at these numbers before Monday will be in a different position than the people who look at them after. Drop a comment and tell me this. Do you own physical silver right now? And if so, how are you thinking about this March delivery situation? Are you holding, adding, watching? I read every single comment. Your perspective genuinely shapes what I cover next. And honestly, in a situation this unprecedented, understanding how real people are thinking about it matters as much as the data. If this kind of analysis is useful to you, subscribe. 3 out of 4 of you watching haven't, and the algorithm shows this to more people when you're subscribed. That's how we get this information to people who need it before the window closes. I'll have another video up shortly breaking down exactly what to watch for as Monday's open approaches. Keep watching, keep verifying, and remember, price is what you pay, value is what you get. Right now, those 2 things are very different numbers.